How to pick the best strike price on Robinhood. Picking the wrong strike price can make the difference between a winning trade and a painful loss. If you've ever wondered how to choose the best strike price on Robinhood, you're in the right place. Today, I'll walk you step by step through everything you need to know, from beginner to advanced. Part 1. Understanding strike prices. First, let's define what a strike price actually is. The strike price is the set price where you can buy or sell the stock if you exercise the option. For calls, it's the price you can buy the stock. For puts, it's the price you can sell the stock. This number is critical because the strike price determines not just your potential profit, but also your risk, cost, and probability of success. Part 2. In the money versus out of the money. On Robinhood's option chain, you'll see a list of strike prices. Some are shaded differently. These are in the money, ITM, contracts. For calls, strike prices below the current stock price are ITM. For puts, strike prices above the stock price are ITM. ITM contracts cost more but have higher odds of success since they already hold intrinsic value. Out of the money, OTM options are cheaper but riskier because the stock needs to move in your favor before expiration. Part 3. The Goldilocks zone, balancing risk and reward. When picking a strike price, think of it like Goldilocks. Some are too hot, some are too cold, and one is just right. Deep ITM contracts, safer but expensive. Far OTM contracts, cheap but low probability. Near the money contracts, often the sweet spot, balancing affordability and probability. Beginners often start near the current stock price because it provides a realistic chance of profit without paying a huge premium. Part 4. Time frame matters. Your strike price choice depends heavily on expiration. With short-term contracts, you may want to be closer to the current stock price since you don't have much time for movement. With long-term contracts, known as leaps, you can afford to pick strikes further away because the stock has more time to reach that level. Always align strike price with your time horizon. Part 5. Considering implied volatility. Another key factor is implied volatility, IV, which measures how much the market expects the stock to move. Higher 4 means options are more expensive across the board. When IV is high, traders often lean towards safer, closer to the money strike prices to avoid overpaying for contracts that may not pan out. When IV is low, you might consider going slightly further OTM since premiums are cheaper. Part 6. Using delta as a guide. Here's a trader's secret. Use the option's delta as a guide. Delta tells you how much the option moves with the stock. A delta of 0.50 means a $1 move in the stock changes your option by about $0.50. Delta near 0.20 equals further out of the money, lower chance of success. Delta near 0.50 equals close to at the money, balanced choice. Delta near 0.70 equals deeper ITM, higher probability, but more expensive. Many traders pick strikes with a delta around 0.50 to 0.70 for a smart balance. Part 7. Practical example. Let's say Tesla is trading at $250 and you're bullish for the next month. You check the option chain. The $240 call is in the money and costs more, but carries high probability. The $260 call is slightly out of the money, cheaper, but requires Tesla to climb. The $250 call is ATM, balanced between risk and cost. Choosing between them depends on your conviction, budget, and risk appetite. Part 8. Common mistakes to avoid. Don't just pick the cheapest option. It's cheap for a reason. Avoid ignoring expiration when selecting strikes, and don't forget liquidity. Always check volume and open interest. A perfect strike means nothing if you can't sell it later. By mastering strike price selection, you're not just guessing. You're building a strategy that puts the odds in your favor. Remember, every contract tells a story of risk versus reward. Take your time, study the chain, and practice. The smarter your choices, the stronger your portfolio becomes, ultimately leading to consistent confidence, growth, and long-term success. Picking the best strike price on Robinhood isn't guesswork, it's strategy. By weighing ITM versus OTM, considering expiration, IV, and using delta as your guide, you'll make smarter trades with higher confidence. If this breakdown helped you, hit that like button, subscribe for more trading insights, and drop a comment with the next option topic you'd like me to cover.